All right, I think we're ready to go. Good morning and welcome to our 2024 Annual Review Open Meeting. My name is Jamie Hott and I am the Chair of Alberta's Automobile Insurance Rate Board. I would like to start this meeting by acknowledging the traditional territories of Indigenous people of Treaty 6 region and the Métis settlements and Métis Nation of Alberta, regions 2, 3, and 4. The AIRB respects the histories, languages, and cultures of First Nations, Métis and Inuit, and all First Peoples of Canada, whose presence continues to enrich our community. We also acknowledge the traditional lands of First Nations, Métis, and Inuit of those presenting and participating from various parts of Canada. The AIRB's mission is to independently regulate automobile insurance rating programs and educate consumers to ensure Albertans have access to a robust automobile insurance marketplace. Therefore, today's discussions are important as they affect nearly 3 million drivers and the insurance companies actively writing private passenger automobile insurance in Alberta. In accordance with the Insurance Act and the Automobile Insurance Premium Regulation, the AIRB must conduct an annual review of automobile insurance trends and premiums relating to basic coverage and additional coverage for private passenger vehicles. As part of this process, the AIRB holds this open meeting to hear presentations from the insurance industry and other interested parties about the review of Alberta industry loss experience for private passenger vehicles in Alberta. To ensure this meeting is accessible to everyone, we have made the decision to hold this meeting virtually going forward. A virtual meeting format enables all interested parties to participate in our annual review without the cost of travel. While we appreciate the interest in discussing opportunities to make auto insurance more affordable for Alberta drivers, the government is currently undertaking a review of Alberta's automobile insurance system and is meeting with insurers and other industry, legal, and medical professionals to discuss opportunities for improvement, which lead to reducing costs, thereby reducing premiums for Albertans. Therefore, I want to reaffirm discussions on product reform are not the purpose of today's meeting. The purpose of today's meeting is to receive input to assist the AIRB in analyzing industry experience to develop industry benchmarks which are used when opining on the reasonableness of insurer assumptions used in development and review the rate filings after October 1st, 2024. According to legislation, the AIRB must consider industry-wide loss costs, administrative expenses, profitability, and any other matters the AIRB considers appropriate. This meeting is an important part of the process the AIRB uses to arrive at its industry benchmarks used as a reference point for rate filings. The AIRB will post the final approved benchmarks on its website before October 1st, 2024. There is a lot of interest in the Alberta auto insurance market and results for drivers, the media, and insurance industry. There are many topics one may want to cover. To be clear, today's open meeting will not address commercial coverage, auto insurance product reform, including the grid rating system, the good driver rate cap, or complaints against insurance companies or insurance industry. In addition, we would like to acknowledge, with all the activity underway to look at auto reforms, the AIRB has not identified any other matters to hear on today's meeting and expects presenters to focus their comments on our benchmarks and loss trends. I would like to remind everyone presenters and presentations who stray into any matters beyond the mandate of the AIRB's review will be redirected and asked to refocus their presentation. Only those parties registered to present will have the opportunity to make a presentation today. Only members and representatives of the AIRB may ask questions of the presenter during the open meeting. Observers or other presenters will not be allowed to question presenters. I want to acknowledge receipt of a written submission from the Facility Association. The AIRB appreciates your contribution to our annual review and will consider comments made in your submission. Just a few housekeeping comments. Before we begin today's presentations, I would like to highlight a few of these housekeeping items. This meeting is being recorded to allow AIRB to review comments made by each presenter. The AIRB will post the recording of today's meeting to its YouTube channel before August 31st, 2024. A link will be shared on our website. AIRB staff emailed a copy of today's agenda with the video conference details, so you should each have a copy. Following this meeting, copies of today's presentations, written submissions will be available on our website at Alberta. Lori, are you on the line? I just want to make sure we give them the right.
Yeah, I am. It's albertaairb.ca.
Oh, thank you. Okay, that's great. Thank you. We request all presenters mute their microphones when not speaking to minimize disruption and ensure all board members, presenters, and observers can clearly hear today's presentations. Before we hear from our first presenter, I would like to introduce each of our board members. Kathy Matten, who's our consumer representative, Jay Jawowski, who is our public member, Ria Lazar-Tip, who is our public member, and Vince Vavrick, who is our public member. We would also note that our Vice Chair, Patricia Matthews, and Superintendent of Insurance, Chris Merriman, both send their regrets. Also joining the board members, we have representatives from our consulting actuary, Oliver Wyman, Lori Balfour, who is our Executive Director, and our AIRB staff. Okay, we can move to agenda item 2, which will be Oliver Wyman's presentation. I invite Mr. Rajesh Saharasbu. Haras. Could you just, are you
Sure.
on the line? I don't want to mess it up.
Sure. No, and can you hear me okay?
Absolutely.
Yeah, so my video has been turned off. I'm sorry. I joined from, we don't have offices anymore, so I have to join from a room. So I'm in a room. I think it's USPHL is what it starts with, -19. Someone turned off my video. I can ask the Encore tech to turn it back on if he's listening.
Great.
Okay, I got it. So, okay. All right. Thank you. So hopefully you can all see me now. And yes, it's a long name. There are a lot of vowels in it. You can just call me Raj. The last name is Sahasrabudhe. But I'm happy to start with the presentation unless you had some additional comments before we do that.
If you could just introduce your colleagues, that would be great. Thank you.
Sure. So I have 2 colleagues on the line, Paula Elliott and Jalen Reichner. I'll maybe ask, Jalen's going to be doing the presentation with me, and maybe I'll just ask Paula to introduce herself before, as I said, because you'll meet Jalen through the course of the presentation.
Yeah, hi everyone, Paul Elliott with Oliver Wyman. We've been, myself, been providing services to the board for well over 20 years, and happy to be here again today to observe and hear all the participants on the annual review of loss trend rates.
Great. And just before you start, I'd just like to mention Oliver Wyman's presentation was posted on our website on June 21st. Thank you.
Okay, great. I think, Laura, you're going to bring up the slides, right? Or
Encore will bring up the slides.
yes, I'm sorry. Yes, that's what I meant. Yes, sorry.
Sure.
Okay, I think you can go to the next slide, I guess, whenever you're ready. Maybe that's where our presentation starts. Okay. All right, so again, we wanted to thank you for the opportunity to present at the meeting today. We know Mother Nature hasn't been so kind in Alberta recently, so hopefully everyone's doing well and everyone is safe, and we can go through the presentation today to relate to auto insurance. Can you move to the next slide, please? Okay, so here's our agenda. We have 7 topics. I think we have 45 minutes, and we want to try to leave about 10 minutes for questions. So we're going to try to get through this as quickly as we can. The first agenda item is economic indicators, because the broader economy will certainly have an effect on auto insurance. Next slide, please. So here's some various economic indicators that we track that might have some level of correlation with with auto insurance costs. Unemployment rate is as people work more, they drive more, and obviously there's more exposure to accidents at that point. That's more of a frequency impact. The next several, the CPI measures are largely related to severity. You'll note that there was the overall severity, there was a little bit of an increase between June 21 and June 22. That seems to have sort of settled down starting with the 22 to 23 period. And again, that's been relatively stable. And you'll see that the CPI X energy has been even more stable across the entire period. And again, that just goes to show that really it's the energy components, gasoline, which are driving the volatility in the CPI metric. The other item the other two items we wanted to mention are bond rates. So we'll talk a little bit about investment income and how that affects auto rates. You'll see that obviously those rates hit quite a low point during the pandemic and have recovered to much higher levels now. And the final item that we've just noted is that there's been a fairly significant increase in the reported population metrics. So we'll see how that affects frequency going forward as well. So next slide, please. So the unemployment rate, as I mentioned, as people are working more, they're driving more, and what we see right now is that the unemployment sort of is generally within sort of the long-term 5 to 7% range, though it has sort of ticked up towards the higher end of that range. And again, that might potentially mean that frequency will be a little bit higher because people are driving more economic activity, can certainly produce more accidents. Next slide, please. Bond yields. So again, there's two principal ways that insurers make money: through underwriting profit and through investment income. And as bond yields go up, they make more money off investment income. So to meet their overall target rate of return, they would need to make less on underwriting profit. Now, I recognize, of course, that in Alberta, that the underwriting profit is set as a percent of premium. So it's a little bit less relevant here, but it just maybe just to understand what the total return for the insurers will be is going to go up just as the bond yields go up. Okay, if we go to the next slide, please. Okay, so our second section is a review of industry benchmarks related to loss costs, and again, these are benchmarks other than those related to losses, which Jalen will review with you in section 3. So next slide. So again, these are benchmarks that we're providing for consideration for filings submitted between October 1, 2024 and March 31, 2025. And it's based on a review of insurance industry data through year-end 2023. If we could go to the next slide, please. So one of the components is unallocated loss adjustment expenses. That's one component of the overall costs. I'll mention, as you can see, they've sort of been rising over time. I will mention that the 22 to 23 numbers you'll see is constant at the 11.8%. And that's really just because the 2020, what GISA did, so this is based on Exhibit 1005, the GISA Exhibit 1005, and the 2022 loss costs were essentially just carried forward to 2023 because there are some abnormalities that were caused by the transition to the IFRS 17 reported basis. So this is something that we're monitoring to see what happens in individual filings, but this is but we recognize that anytime there's an accounting change, there's a potential for costs to shift, and I think GISA observed that and then kept the provision constant for the current year. The other component of loss adjustment expenses is what's called allocated loss adjustment expenses. So they're generally legal expenses that are associated with individual claim amounts, and we review those in conjunction with the loss amounts. So we'll cover those in the following section. So this is just the unallocated side. Next slide, please. This is another slide just reviewing the investment income rates. So again, we sort of saw this earlier on, but you can see that they've been in sort of they were in sort of a range pre-pandemic. Bond rates were cut pretty significantly during the pandemic, and then during the period of inflation, where governments tried to bring that down, those rates have recovered to all-time highs for purposes of this slide. We will note that that the 2023 rate there, so this is the insurer rate on the right side, the industry pre-tax return on investment, excludes one large writer that had a reporting error, and they've been excluded from the data. We did confirm with GISA that there indeed was a reporting error related to that insurer. Okay, next slide, please. The health cost recovery, again, just briefly, that the AIRB's position has been to accept the government rate as the benchmark, and that's currently at 2.94%. If we could go to the next slide, please. Here are the other non-claim expenses that insurers need to incorporate into their expense into the overall premium. So you see the categories down the left-hand side. You'll see that the rate is relatively unchanged between the semi-annual review and the annual review. One of the things that I just want you to keep in mind before we go to the next slide is that many of these expense components are directly proportional to premium. Taxes are a percentage of premium, commissions tend to be a percent of premium, and some portion of general expenses are also going to be proportional to premium. So if we could go to the next slide, please. One of the stakeholder comments from our preliminary report was an observation that acquisition and operational costs for the insurance industry continue to rise. And so we wanted to sort of give you some context around that comment. So we're providing the expenses per earned vehicle here. And really, it's what you sort of see is that there was a rate of change sort of pre-pandemic that approximated around 5%. So this is where you see it sort of a little bit flatter on the left-hand side. Then there's those two periods where the increase is much more steep, and this is sort of the in-pandemic period. And then the post-pandemic period, you'll see again, it's just 2 points at this time. But that sort of leveled out. That rate of change between 21 and 22 is only 2%. And so one of the reasons why in the prior slide I wanted to emphasize that that many of the cost components are measured as a percent of premium is that much of the increase that you see here is essentially a ride-along effect that occurs when rate changes are approved. So rate changes are approved, particularly rate increases, I should say. When rate increases are approved, then the commissions go up, taxes go up, and that's part of the reason, maybe the major part of the reason for the for the increase for the rate of change in the expenses. Again, it's just slightly over general inflation pre-pandemic, and then during the pandemic, it was certainly higher. If we could go to the next slide, please. Okay, so profit, again, as we discussed, there's two sources of profit, investment income and underwriting income, and the board's position is unchanged that the underwriting profit provision should be 6% of premium. Next slide. Okay, so with that, I'm going to pass it over to Jalen to briefly introduce himself and go through the loss trend metrics.
Thanks, Raj. Yeah, hi, my name is Jalen Reichner, and I've been supporting the Canada business here at Oliver Wyman for about 2 years. And again, just wanted to thank you for your time for letting us to present. Next slide, please. So here we present our loss trend rates compared to the loss trend rates that we selected in our prior review. And largely, you'll see that most of them are fairly unchanged, which is what we typically expect. But the two main deviations from our prior report are bodily injury, where we no longer select a tempered future trend rate, and then accident benefits, where we now do select a tempered future trend rate. And so we'll provide some data and look at that a little deeper in the next couple of slides. Next slide, please. So as we get new data, the estimates that underlie our trend rates change sometimes. And I want to point your attention to the middle graph, which is our severity estimates for bodily injury. And as you can see, so the light blue line is our estimates in the prior review with data through June 30th, 2023. And what you can see is after 2020, after the reforms were implemented, it seems that the trend rate is a little less steep than what it looked like before, which was the rationale for our tempered future trend rate in our prior review. Now, when we received data this year and compiled it, our estimates increased, and you can see in the black line now they're above the light blue line. And that tempered future trend rate doesn't really seem to be as supported now. So that's kind of some insight into why that changed. Next slide, please. And looking at, so this is the data with our model along with the data. So the light blue line here is our model. And you can see, especially in the short-term view on the right side, that post-2020, it doesn't seem as flat. And so that tempered future trend rate of 5% didn't seem supported. And so, yeah, you can see that we selected the higher trend rate. Next slide, please. Property damage. So I'll just go quickly over this because it's relatively unchanged. The one thing I do want to point out is that you can see in the frequency, unlike bodily injury, the frequency level appears to be almost back to the pandemic level, which is a little opposite of what we would expect, considering, as Raj said earlier, that with less driving, and especially with bodily injury, with less driving, we would expect less accidents, and we can see the frequency level is lower, but here it's higher and back to the pre-pandemic level. And I'll talk about this later as we go into the reforms, but I just wanted to point that out to keep your attention there. Next slide, please. For accident benefits here, so you can see with our model, especially in the short-term view, after 2020, there appears to be a change in trend. The trend that we see from approximately 2015 to, say, 2020 appears a lot steeper than what we see after the reforms were implemented. And so we wanted to recognize this, and we recognize this in two ways. One, we see a little lift between the first point in 2020 and the second point in 2020, which we recognize through a scalar. And then we also recognize that flatter trend as a change in trend rate. So before the reforms, we select a trend of about 13%, and after the reforms, that drops down to about 4.5%. So we see a little lift with the reforms that were implemented, but we now no longer see that the change from period to period is as steep as it was before the reforms. Next slide, please. Collision. So again, I'll just go over this quickly because it's relatively unchanged. But you can see here that opposite of the property damage graph that we saw a couple slides earlier, the collision frequency is way down. And in those last 3 points, you can see that it's still decreasing. And we think this might be some of the effects of the introduction of DCPD. And we'll look at this closer. But again, just wanted to bring your attention to that. Next slide, please. With comprehensive, you'll see that's a very volatile coverage. There's a lot of seasonality, and it bounces a little bit in between periods. But relatively, the trend is relatively flat. We have not gotten the updated catastrophe data. So once we receive the 2023 catastrophe data, we'll look into this a little bit more and update as needed. But our trend rate selection is unchanged from our prior report. Next slide, please. And finally, comprehensive theft, just looking at the individual component within comprehensive, we see that in the frequency level, there was a jump between 2021 and 2022. So we saw a slight increase there, which we recognized through a scalar, but the decreasing trend rate that we saw prior to those periods has continued in the last couple data points. So it doesn't appear to be rising as steeply as we see in some other provinces. I will point out that the latest data point that we have for the severity, we do see a big uptick in the severity. So we're keeping an eye on that to see how we expect that to continue in the future. Next slide, please. And with that, I'll pass it back to you, Raj.
Hey, thanks, Jalen. We could move to the next slide. Okay, so now we're going to review the impact of inflation that we've seen recently, or the higher levels of inflation that we've seen recently, and sort of where what we're seeing sort of most currently on that topic. So in terms of past loss cost trends, so this is what is December 31st, 2023 and prior. So here are sort of the various charts that sort of show the changes in average severity. And what you'll notice is that the middle two panels in height, the property damage and collision, you see a much steeper increase there than you see in, for example, the top two panels for bodily injury and accident benefits. And the reason for this is that the underlying cost components for the physical damage coverages, property damage and collision, are rising at a much higher rate during the inflationary period than for example, healthcare costs, which seem to be lagging a little bit. And those are the primary drivers of bodily injury and accident benefit trend rates. So if we go to the next slide, please. So in our report, we have charts just sort of looking at general inflation. Again, as we mentioned at the outset when we went through the various economic indicators that we think have an effect on insurance prices, and inflation is obviously one of those items. We look at both the all items inflation, but then we drill into the items that are more directly related to auto insurance. So transportation, you see there again, it was much higher, and now that inflation metric, or that CPI metric, has receded and sort of flattened out. You could go to the next slide, please. You see the similar pattern in these next two components: purchase and leasing of vehicles and rental of private passenger vehicles. So again, where it's higher but seems to have returned to pre-pandemic levels. Next slide, please. And here's a real important one on the top the top panel, the passenger vehicle parts, maintenance and repairs. So that hasn't quite returned. It's returned from the highs, but it hasn't quite returned to the pre-pandemic levels. So like we see with the other cost metrics. So our general expectation is that it will, but we don't quite see it in the data yet. And again, you see healthcare costs didn't rise nearly as steeply as some of the other components did, and they are also starting to return, but have not yet returned to the pre-pandemic levels. Next slide, please. So that's sort of looking in the rearview mirror at what happened with loss trends. So, but if we look out the windshield instead of looking at the rearview mirror in terms of future loss trends, what we want to look at is for the future is we want to understand what's happened in the past, and then try to use that information along with other data to hypothesize what's going to happen in the future. And obviously there's essentially three options. Inflation may stabilize, it may fall, or it may rise. And we no longer provide recommendations on future loss cost trends, but I guess our recommendation is in the last bullet, where we recommend flexibility in allowing insurers flexibility in their determination of future trends. and in particular, to the extent that they can support a different future trend at the time of the filing, which will certainly be beyond December 23, we think that should be considered in evaluating the reasonableness of their future trend rates. Go to the next slide, please. So here are the observed severity changes. So there's two panels for each coverage. We have the top panel sort of has the progression over time, and then the bottom panels have the trailing 12-month changes, and with a line sort of designating the pandemic the pandemic period, or the higher inflation period. So, and the red dots are those that are in excess of 10%. So we'll see sort of for bodily injury that we had a lot of points that were in excess of 10% prior to the period of high inflation. And then we've had some points that are generally lower, with one exception afterwards. And again, that we believe is going to be, is certainly the reforms have an effect on bodily injury costs, and that's one of the explanatory elements of that. Similar pattern on accident benefits, where we are seeing more points that were in excess of 10% prior to the period of high inflation, and now since then they have been lower. Go to the next slide, please. And we see sort of the opposite effect on the physical damage coverages, right, where it was a lot more stable and fewer red dots to the left of the inflation spike and more red dots to the right of the inflation spike. So this is really consistent with what we had in the previous several slides, just showing that that's really the impact of inflation was really felt more acutely on the property damage, physical damage coverages, whereas on the healthcare side there was a little bit of a less of an effect, and then at the same time you had the effect of the reforms, which hopefully mitigated what effect there might be. Next slide, please. So that's good natural segue into the policy reforms, which I'll turn back to Jalen.
Thanks, Raj. Next slide, please. So as Raj noted, there's some reforms that were implemented in the past couple of years that we need to consider when we select our models. The first one is Bill 41, which mainly affected bodily injury and accident benefits. And so before the reforms, we estimated that the bodily injury loss cost would decrease and that the accident benefits loss cost would increase. I'll acknowledge that we do still have limited data post-reform, considering that almost half of the data that we have post-reform is also muddled with COVID. So we are still continuing to monitor how the reforms have affected loss costs, but we do still try to estimate it. And what we're seeing is that as of December 2023, the bodily injury reduction is not as large as we expected. Right now, we estimate a minus 11.1% as compared to our initial minus 18% reduction. And for accident benefits, we're estimating a larger increase, plus 13.5% compared to our initial plus 8%. I will note that we had a stakeholder comment point this out. In our initial estimate for the bodily injury reduction, approximately 3 to 4 points of that estimate was associated with the prejudgment interest savings. And so the higher inflationary environment that Raj mentioned earlier has almost wiped these savings out. So that's part of the reason why we're not seeing as large of as a reduction to the bodily injury loss costs. Next slide, please. So here are our models that we use to estimate the bodily injury and accident benefits trend. I just want to point out two things. So in our bodily injury models, the reform scalar isn't significant individually in the frequency and severity model, but it is significant in our loss cost model. So we did choose to include it, even though it is not significant in the individual models. And again, for accident benefits, adding those red lines, I think, makes it a little clearer to see the period where we can see that change. And I think it really illustrates how after the reforms, after 2020, we do see a different trend rate, which again, we recognize by a scalar in our model at the reform and then a lower future trend rate. Next slide, please. The second reform that we have to consider is the introduction of DCPD, which we're seeing effects on both the total property damage and the collision experience. Since we only have 2 years of data, we look at total PD and do not look at property damage and DCPD separate. As we get more data, we'll look at separating them out, but as of December 2023, we keep them together. Next slide, please. And so I mentioned this earlier, but what we're seeing is that property damage appears to be almost back to its pre-pandemic level, while collision seems to be way down. And Alberta isn't the only province that we've seen this happen with the introduction of DCPD. In Nova Scotia, we saw this. And in comparing the two, the reduction or I guess the change, the shift from claims from collision to DCPD was a little bit smaller. In Nova Scotia, we see about a -15% drop to collision and then a +15 offsetting increase to property damage, where in Alberta, it's about 20%. So it was a little bit less, but we do still see the same story. And so just to go a little bit further into this graph, so the black line is the combined experience. And what you can see is that the black line in 2022, 2023 has not returned to the, say, pre-pandemic levels, the 2018, 2019 level. And so we can think of this as like a COVID effect. So due to the lower driving patterns, we see less accidents. The light blue line is the total property damage, and you can see that if we account for trend, it's almost back to the pre-pandemic level, while collision is approximately 40% lower. So what our initial thoughts on this are that there's about, for collision, a 20% drop due to COVID, and then another 20% drop due to the shifting of claims to property damage. And then for property damage, we're seeing about a 20% drop from COVID, and then an offsetting 20% increase from the shift of claims from collision to DCPD, which that results in a net zero. So our initial expectation is that this really shouldn't happen. In theory, this shouldn't happen. A couple initial thoughts on why it could happen. There are lower DCPD deductibles, so an insured might be more likely to pursue a DCPD claim than a collision claim. Insurers, prior to the introduction of DCPD, may have been more likely to contest a PD claim as it's coming from another party, as opposed to a DCPD claim that's coming from their own, say, customer. And then another reason that we've seen recently is that insurers may have previously been using collision and then subrogating the other party's insurer rather than using the PD coverage, whereas now it's just coded as DCPD. So those are three possible reasons that may help explain this shift. We'll continue to monitor it, and we have seen it in other provinces. But yes, we are seeing that property damage has increased while collision has decreased. Next slide, please. Raj, I'll pass it back to you to talk about the new normal.
Thanks, Joe. So our last topic before profit, which we may bypass in the interest of time, is our analysis of the effects of COVID-19 and what we're calling the new normal as it relates to driving habits. Next slide, please. Okay, so as we know, that there were various stay-at-home orders during the pandemic, which caused a significant reduction to reported frequency. Again, we've gone through that on the loss frequency slides. At the same time, we had these the Bill 41 reforms come into place and the introduction of DCPD. So there were lots of varying lots of drivers of changes in auto insurance costs sort of happening at the same time. When auto insurers develop their estimate of future rate need, what they need to do is adjust prior loss costs to forecasted future levels. So they essentially need to unwind some of these effects, but then but then there is sort of a future effect related to the new more common hybrid and remote work options. So sort of the combined effect of that is what we're calling a combined new normal factor. And I'll I'll just go through one coverage just so you understand sort of how that works. But before I do that, I'll mention that there were two stakeholder comments on our combined new normal factor. One was related to the board's evaluation of the stability and loss costs, and particularly bodily injury, where there's a fairly high trend rate. That the comment was that the stability of loss costs should not only consider that higher trend rate, but then should also consider the offsetting effect of this new normal factor, or the future impact of hybrid and remote work options. And the second comment was a request for additional details on the calculation of these factors, and so we are working on that, and we'll incorporate that in future reviews. If we go to the next slide. I won't go through all of the coverages because, in the interest of time, because they all are essentially all sort of the same. But what you see in the top chart is you see the historical bodily injury frequency data, where you'll see that the counts were higher. They dropped during the pandemic and then have recovered somewhat. So it's a general pattern that we see across many coverages. The issue with property damage that Jalen discussed notwithstanding. So what you essentially have is, we believe that the pre-pandemic experience needs to be reduced to capture the effects to get down to the current level. So I'm talking about now the bottom of the three panels. You'll see on the left side of the chart, there's arrows pointing downward. So to get a reduction down to the current level. The in-pandemic experience needs to be increased to get to the current level. And then obviously what we're seeing now is what we are calling the new normal. So that's effectively the adjustments that we believe are appropriate, and we quantify that through these factors that we present on the right. And we have similar tables for bodily injury and the other, bodily injury, property damage, accident benefits, and collision. Those are the coverages where we see significant impact of the pandemic. So I think we are at our target time anyway in terms of presentation. I think we were asked to leave 10 minutes for questions. So we could either skip over the profit section, or we could go straight to questions. Lori, is there a preference on that?
I think if you could do the profit section, that would be great. The board had
Okay.
the opportunity to ask you questions at the June meeting, so I think we'd rather hear your presentation today.
Okay, thank you, Lori. All right, I will pass it back to Jalen to do the profit section. If we could advance a few slides.
And maybe just before that, you have about 8
Yes.
minutes left, just so you know.
Yes, thank you.
Thank you.
I think it's maybe 2 or 3 more slides, please. Perfect, thank you. Yes, so discussing profit. So we see 2020 and 2021, due to the less driving that occurred during the COVID-19 pandemic and the stay-at-home orders, there was just less driving and less accidents. So we see profit results that were much higher than what we see prior to the pandemic. And so we note that these profit levels aren't representative of those profit levels or even profit levels that we may see post-pandemic. In the recent years, we see 2 government orders that will affect profits. During 2023, there was a rate pause where insurers weren't able to take rate increases. And then now for 2024, which is not reflected in our data yet, but will be reflected in the next review, we see a rate cap for good drivers. So this limits the amount that good drivers, how much their rates can increase, which again will affect insurer profits. We do see we did get 2 stakeholder comments regarding the profit. We had one that says that by certain measures, 2023 insurers are seeing high profits, which may suggest that those high profits from the pandemic haven't come down yet. So we will continue to monitor them and see how insurer profits are, the experience of insurer profits after the pandemic. And then we got another comment that looked at a longer term view over the last 10 years, and provided some concern about the profit levels in Alberta and insurers leaving the market. Next slide, please. So here we provide a longer term view of the profit levels that we see. And as you can see, so the dark blue line is the basic coverages, and then the dark gray line in the middle is the combined. And what you'll see is that they're both significantly above the target profit for most years prior to the pandemic. Then you can see they dipped down below the target in 2020 and 2021, which resulted in those high profits. And then now we can see they're starting to come back up. Next slide, please. And so looking at a shorter term view, you can see that prior to 2019, we see a negative profit. And again, this was the story for most of those years, not just 2019. And then in 2020 and 2021, we see high profits, which reduced after 2022 as drivers were driving more. Also in conjunction with the rate pause for 2023, we see that profit did not rise to the in-pandemic levels, but was above the benchmark profit provision of 6%. And so as we go into the future, we'll monitor if we see this trend increasing or how profit will play out in the future. And I think that is our last slide.
All right. Well, thank you, Raj, Jalen, and Paula for your presentation today. And Raj, once again, my apologies for messing up your last name.
So in the future, I'll also let you know when I'm joining from a room. I think I had a little bit of a glitch at the very beginning because I joined from a room, so it didn't come up under my name.
Perfect. All right.
Thanks.
Thanks for your time.
Thanks, Jim.
Great.
Have a great
Thanks.
day.
Bye.
All right. We're going to move now to agenda item 3. And we will now hear from the ARB's consumer representative, Kathy Mattin. So Kathy, you can take it away.
Kathy, you're on mute.
Thank you so much. Sorry, guys. All right, we'll start over. Good morning. I am Kathy Manton, and I was appointed the Consumer Representative for the Automobile Insurance Rate Board, AIRB, this year and served as a public member prior to this appointment. I am pleased to present for the first time my report to the board at the annual review meeting. In my role, I ensure that Albertans have a voice at each board meeting as well as here today. Today, I will be sharing with you the highlights of a survey we conducted to collect information and sentiments from Albertans about their automobile insurance. Next slide, please. This slide shows the demographics from this year's survey. All participants had to be 18 years of age, responsible for the purchase of vehicle insurance for their household's private passenger vehicles, and their vehicle must be for on-road use. To ensure the survey was statistically representative, we monitored participants to ensure balance for Edmonton, Calgary, and other urban and rural areas. Other monitored demographics include gender, age, and years of driving experience. The total number of respondents for the 2024 survey was 1,000, with 631 respondents participating in the online survey and 369 respondents by telephone survey. Next slide, please. Over the years, our work with consumers has identified 4 main consumer expectations. Affordability has been a theme for us for many years. It's not new. Insurers want their premiums to be aligned with their risk. Consumers want to avoid unexpected increases at renewal, and they want to understand any change in their premium and what is causing it. The next consumer expectation is stability. Alberta drivers understand costs go up over time, and they see it with everything that they're buying, but they want stability and to be able to budget for an increase and not get unexpected increases unless they have had an at-fault claim or a traffic conviction. The third expectation is accessibility. Albertans are required to purchase auto insurance, and they want to be able to find the coverage they need at a price that they can afford. Price factors into accessibility. If you cannot afford it, you cannot access it. The final expectation is customer service. While we hope to never experience the claim service, hoping to never be in an accident, this is where the insurer can stand out and demonstrate their claim service. Customer service at the time of purchase and at renewal are equally important. The AIRB often gets calls about premiums and difficulty in shopping the market. There's been a dramatic increase in call volume over the last 2 years. Next slide, please. We made changes to the survey this year to gauge Albertans' awareness of the role government plays in regulating automobile insurance rating programs. Only 46% of the respondents knew that the government of Alberta regulates automobile insurance. This stands out because Albertans may not know to turn to government when they have issues or concerns with their insurer. Edmonton respondents, 56%, were more likely to be aware of government's role in regulating auto insurance. Next slide, please. This result was less surprising. 69% of respondents had not heard of the AIRB. This question will give us a good baseline for future consumer education activities. We will be able to measure if awareness of the AIRB increases. The AIRB has a mandate to educate consumers, and through a budget increase this year from the government of Alberta, we will be undertaking activities to reach more Albertans and help them become empowered insurance consumers. Next slide, please. We asked respondents to self-assess how confident they feel when buying automobile insurance. Personal confidence can be very important when buying insurance. A confident buyer may be more successful because they are aware of their options, and they are likely to engage in comparison shopping. It can also make someone more assertive in seeking discounts or asking questions about their policy. While confidence is high, when asked a specific question about direct compensation for property damage, or DCPD, 66% of respondents had not heard of it, despite it being introduced over 3 years ago. This brings up the question about whether some respondents are overly confident without completely understanding the product they are purchasing. Next slide, please. The survey asked, at any time in the past 2 years have you sought competitive quotes? The results indicated more consumers sought competitive quotes in 2021. Since that time, there has been a drop-off. It is a little disheartening that only about half of those surveyed comparison shopped. Interestingly, those most likely to have sought competitive quotes are males versus females, Edmonton and Calgary versus other urban or rural, and those aged 18 to 34. Next slide, please. As consumers are experiencing higher automobile insurance rates, it is critical that they are aware of the factors contributing to these increases. With a better understanding of the factors, consumers' opinions on the fairness of premiums may change. When asked, were you aware the following factors contribute to the rising cost of insurance? Many Albertans demonstrated a high level of awareness for some of the factors contributing to increased rates. Male respondents were more likely to be aware that automated features such as lane control on newer vehicles are costly to repair. Female respondents were more likely to be aware that claims involving distracted driving are increasing. And respondents aged 55 and up were more likely to be aware that Alberta is the vehicle theft capital of Canada per capita. Next slide, please. Agreement with this statement, automobile insurance premiums are fair and reasonable, is a question we have tracked for a number of years. The percentage of consumers who have a high level of agreement with the statement has improved since 2023. 29% of respondents have high agreement with the fair and reasonable statement. If you go back to 2009, 75% of respondents had high agreement with that statement. It's a huge change in public sentiment and one that we continue to monitor as an important indicator of consumer confidence. Next slide, please. We asked residents if in the last 2 years, they or anyone in their household experienced an unexpected increase in the cost of automobile insurance, although having no claims or convictions. More likely to report that they experienced an unexpected increase in the cost of their auto insurance, Calgary versus rural, and those 18 to 54 versus those 55 and plus. Next slide, please. Many Albertans rely on their broker or agent to provide information about why premiums are increasing. 59% of respondents contacted their broker or agent for explanation. However, survey results continue to indicate information provided by brokers and agents was not sufficient. Of those consumers who experienced rate increases in 2023 and reached out for an explanation, 65% of them were dissatisfied with the response. Insurers rely on their frontline staff and partners to relay important information to customers. We feel that educating the customer-facing staff about market and trends in Alberta is an important part of the customer education strategy, and we have held a few educational events for brokers and agents in the past year. We will continue working with our educational partners like the Insurance Brokers Association of Alberta and the Insurance Institute to provide customer satisfaction when they reach out to their broker and agent for answers. Next slide, please. We continue to ask respondents, are you driving the same amount, less, or more before the start of the pandemic in March of 2020? More likely to say that they are driving more, Edmonton and Calgary versus other urban areas, and those 18 to 34 versus 55 plus. More likely to say less, Calgary versus Edmonton, and those 55 plus versus 18 to 34. Next slide, please. In closing, Albertans were very clear in their survey comments. Affordability is their top concern, with 72% of comments falling into the insurance rates are too high category. There's always much more which can be done to improve consumer confidence in automobile insurance in Alberta. It will take the joint effort of government and the insurance industry to build up consumer trust through education and transparent communication. I look forward to working with all of our partners to achieve this goal. Thank you very much.
On behalf of the AIRB, I thank Kathy for her presentation and report on consumer perspectives. The concerns and challenges of Alberta drivers are certainly a central focus of discussions at the AIRB. Now we will move on to presentations to hear comments on Oliver Wyman's review of industry experience. Each presenter will have 20 minutes, including 5 minutes for questions the board members may have. I will give you a warning when there are 8 minutes remaining, so you have a chance to wrap up and leave time for questions. So we will now move on to agenda item 4, where we have the Alberta Civil Trial Lawyers Association represented by Owen Lewis, past chair. Karen Verlew, geographical district representative for Edmonton, and actually I'm not sure if he's been actually able to attend, and then Craig Allen, ACTLA's consulting actuary. So you can take it away.
Thank you, Mr. Chair. Appreciate that. As mentioned, joined by Craig Allen, our consulting actuary, who is responsible for the preparation of the actuarial report, which was provided to the board, and also our executive director, Joy Jung. Appreciate the opportunity to speak before the board today with respect to the Oliver Wyman draft report and also the comments on behalf of those that are dealing with the industry on a daily basis. For those board members who are new and or who haven't had the displeasure of having to see me for the last 5 years, I'd encourage you to review our annual reports and comments on the Oliver Wyman reports. We're not able to comment on everything that we see. Some of what we've presented previously has not changed and has actually only increased. We're focused our attention today on the matters that are brought up in our presentation. But again, there's about a 100-page report. I don't want to bore you, but it contains an awful lot of additional information. So if we could move to the next slide, please. Our presentation today will focus on factors in relation to the report, but our perspective is we believe that Albertans deserve more affordable auto insurance, expanded consumer choice, and a fair system. To address that, we need to understand what are the cost drivers that are causing premiums to increase at the level that they are, and to understand the profitability of the industry. And for the AIRB, and I appreciate that you have a very good understanding of all of this, but for our perspective to be heard in terms of what we see in some of the actuarial numbers, both on the basis of what Oliver Wyman is seeing as well, but on some of the things that we believe we've seen in the reviews, the GIZA data, which might not necessarily be explained by the Oliver Wyman report. So if we go to the next slide, please. So some of the observations that we have is both Oliver Wyman and Craig Allen still project healthy pre-tax profits for the auto insurance sector. In past years, we've indicated that we believe that the profits would continue to be there for the insurance industry, and they certainly have. Now, again, in past years, Craig Allen has used different metrics. In terms of this year's, we're simply using Oliver Wyman, and we're using the Chang method, which again was a government actuary used in one of the court challenges that was brought. The second point, and we'll get into all of these, bodily injury claims costs continue a trajectory of stability. We said for years that since 2016, bodily injury claims costs had leveled off and decreased significantly since COVID. And still we see a situation where bodily injury claims costs are lower than they were pre-pandemic. 3, the acquisition operating costs of the insurance industry continue to increase. And I know there was mention of that in Oliver Wyman's presentation, and we'll get into that a bit more. The new normal driving pattern multipliers. And I appreciate that Oliver Wyman provided a little bit of information on that, but I don't think it's typically understood as to how the new normal, which has only recently been accepted by Oliver Wyman, because in previous years, none of the projections took into account Bill 41 or COVID. And we'll get into that a little bit more in terms of what that new normal means. And property damage claims costs per vehicle continue to rise. Again, Oliver Wyman commented on this. It's property claims that are the driver of premium increases, not bodily injury. So if we could go to the next slide, please. So this is the profits, and bearing in mind that actuaries are going to have different methods of calculating the profits based on reserves and a number of other factors. What we see, though, is a situation where there is still a very healthy and profitable insurance industry, a situation where regardless of which numbers you want to take, and let's take for the moment that the Oliver Wyman realized profit provisions are the ones that are accepted. The numbers are still significant. So it's a situation, as Oliver Wyman mentioned, the pre-tax profits exceeded the 6% benchmark in 2023. Based on Craig Allen's projections, it's still a situation where there is going to be a healthy insurance industry in 2024 based on the benchmarks which have been identified by Oliver Wyman, taking into account the new normal adjustment which needs to be done, as well as the projected increases in the premiums. So no matter which method is used, and as I mentioned, the Chang method is one which was employed by a government actuary at the time that there was a constitutional challenge. And that's kind of the explanation of the two different methods. If there's any questions on that, I'll certainly let Mr. Allen explain those. So if we can move to the next slide, please. So the pre-tax profits, and I commented a little bit on this in terms of what's been identified by Oliver Wyman, is that it did exceed the 6% in 2023 using the Oliver Wyman calculations. But when you use the Craig Allen realized profit provisions, they're actually significantly higher. And again, this goes to some of the information that we have in previous presentations, where we look at some of the Giza data, the cautions, and the increase in the reserve practices of insurance companies in Alberta. So the indication, I know this was mentioned in Oliver Wyman's report, that somehow the insurance industry isn't profitable and businesses are leaving Alberta. The two that have indicated that they will leave are small subsidiaries of larger insurance companies. If it's a situation that there's only two insurance companies in Alberta that are making all of this profit, then they must be incredibly profitable if everybody else is losing money. And if that's the case, certainly a situation where one would question then the business practices of some of the other companies. So if we can move to the next slide. Bodily injury claims costs continue a trajectory of stability. Oliver Wyman commented on this as well. However, I note that the focus is always on severity, and that's where the benchmark increases come at the 8.5%, again, without taking into account a new normal for post-COVID in Bill 41. But when you look at the actual numbers, and these come from Oliver Wyman, the only thing that's been done is that we've adjusted for inflation to 2019 dollars. But the bodily injury claims costs per vehicle have dropped since 2019, and they've maintained stability during that period of 2021, 2022, and 2023. If you go back to past presentations, we were told consistently driving patterns have gone back to where they were pre-pandemic. We expect that bodily injury claims costs are going to skyrocket. We expect that they're going to exceed what they were pre-pandemic. None of that has come to pass. And we've indicated that throughout in our past reports. But now with the benefit of hindsight, we're able to see that the bodily injury claims costs have not increased. They are not skyrocketing, and they are not the reason for any increase in premiums, certainly since 2019. Even if we looked at nominal dollars, and I'd refer to page 31 of Oliver Wyman's report, the loss costs in 2019 was $495.65. And today, even with inflation and everything else, it's less than that at $464.12. Bill 41 has had an impact, and I was happy to hear that Oliver Wyman is now recognizing and looking at some of those impacts when they look at the new normal. In past years, when looking at the benchmarks, Oliver Wyman did not take into account the impacts of Bill 41 and did not take into account the impacts of COVID. However, with the new normal that is to be calculated in, it's heartening to see that acknowledgement. If we can move to the next slide. While bodily injury claims costs have stabilized and actually reduced, it's a situation where we see the acquisition and operating costs of the industry continue to increase. Again, I appreciate Oliver Wyman's comment on this. It is a situation we acknowledge and we've stated that inflation is a factor, and that it is a situation as well where there are more policies being purchased. That's going to impact things. It's been a while since I had to take Economics 101, but we've got certain fixed costs and we've got variable costs. And we have a situation where the operating expense percentage has gone up, the premiums have gone up, and the number of premiums have gone up. So one would expect that there'd be some type of review as to where these numbers come from. And as we understand, it really is just taken from what it is the insurers provide as data to Giza. Giza then takes those numbers in the aggregate and it's applied throughout. But what we do see is a significant percentage increase when you look at 2014 to 2023. And when you factor in the increase in premiums, as well as the increase in the insured vehicles, that's a significant increase. The projected at 27.6% for this coming year means that 27.6 cents of every premium dollar is paid for the operating costs, acquisition costs of the insurance company. That goes to pay administrative salaries, advertising, which we see on the television on a fairly regular basis. But in addition, it's the acquisition costs, which are paid to the brokers, as well as, in some cases, the insurance companies themselves or the brokerages which are owned by the insurance companies.
Oh, and I'm just going to give you the 8-minute time warning.
Thank you, appreciate
you.
that. So next slide, please. We've discussed some of the acquisition costs. Again, that's what's being paid to brokers. That shows the significant percentage increase as well as the dollar increase for every premium, which is paid by consumers, and the percentage which goes to the brokerages. If we can go to the next slide, please. This is the one where Oliver Wyman is now acknowledging a new normal and taking into account the post-COVID driving patterns as well as Bill 41 to some extent. We've asked for the information. I appreciate Oliver Wyman is going to look to provide that. But if one were to simply look at the past reports and say, oh, bodily injury claims costs are increasing 8.5% per year, and that's been consistent since 2019, that's not the full picture. And I think that's acknowledged by Oliver Wyman. When you look at those benchmarks, you need to apply this new normal. You need to apply the fact that bodily injury claims costs have dropped as a result of Bill 41 and also dropped as a result of post-COVID driving. There's focus on severity without the acknowledgement that the frequency has actually dropped significantly from 6.43 in 2019 per number of vehicles to 4.58 in 2023, a significant reduction from 2019 to 2023. And of course, that plays into these numbers, which look at what the per vehicle cost is and the new normal adjustment. We can move to the next slide, please. It's acknowledged that it's property damage and those types of things which are impacting premiums. Now, the one comment that I'd like to make, it was mentioned that there's been a shift from collision to DCPD. There were a number of reasons which are expressed for that, but one other reason is that you're suddenly shifting the loss costs from what is optional coverage, collision, to what is basic mandatory coverage, DCPD. So we know that the costs for property damage have increased, and we know that there's been a shifting in the industry from collision to DCPD, unexplained, and that was that 20% increase that Oliver Wyman talked about in that shifting in their presentation. Next slide, please. So in conclusion, the new normal driving patterns have resulted in stable bodily injury loss costs consistently below pre-pandemic levels. Property damage claims costs have increased. It's essential for the AIRB to incorporate these current and accurate trends into the benchmark calculations. And secondly, we'd ask that there be a critical assessment of the operating expenses and acquisition costs submitted by insurers to determine if proposed rate filings are justified. I've gone over a little bit, but I'm certainly open to any questions which the board might have. Thank you again for allowing us to present.
Thank you, Owen and Craig, for your presentation. I do have a question. Mr. Allen's calculation of a realized profit as a percentage of premium significantly diverges from Oliver Wyman's calculation beginning in 2021. Can you explain the key drivers of the difference in how the realized profit is measured between Mr. Allen and Oliver Wyman, and why differences began to significantly diverge beginning in 21?
I will
Yes.
defer to Mr. Allen on that.
Great.
Yes, the primary differences are taking account of a change that I see in the reserving practices of the industry. There was a sharp and distinct and continuing change that began in 2017, And it's noted in Giza's notes to users that that there's been a strengthening in reserves. And so in my view, we've seen the first stage of that, and there's another shoe to drop, which is that the patterns of increase in estimated claims costs will drop off because there's been an earlier recognition of the value of the claims.
Okay, great, thank you. Could you stop sharing your presentation so we can see folks?
And I don't think that's within my control, so I'll leave it to
Oh, okay.
whoever's in control of that.
Whoever has control.
Thank you. And I guess to supplement that, that is information which is presented in the report itself, as well as numerous past annual reviews that we have done discussing those caveats under the Giza note to user and the reserving practices.
Okay, great. Okay, I think how much time do we have left? We have a few minutes left. I think Vince might have a question for you. So Vince. Oh, and Encore, can you just take down the presentation so we can see people for now, please? Thank you. Vince, I think you're on mute.
Thank you, Mr. Chair. Sorry, I've been able to, I was able to follow along, and now I've lost track of my materials here. So I'm afraid I'm going to have to defer this one.
Oh, okay, no problem. Okay, well, that pretty much puts us at time. So thanks again, and have a great rest of your day.
Thank you. And if there are questions, certainly happy to answer those outside of this or within this process as well. So if Mr. Vavrick has questions, happy to answer those at a later time.
Great, thank you.
Thank you.
All right, we're going to move on to agenda item 5, where we have the Insurance Bureau of Canada presenting. Representing from IBC, and I think Aaron wasn't able to attend, but we have Hannah Baydoun, who is the manager of policy. So go ahead, Hannah.
Thank you so much, Mr. Chair, and good morning, everyone. I'm just going to adjust my camera a little bit. I am in a hotel room, so the camera might be a bit off. So thanks for having me today. My name is Hannah Baydoun, Manager Policy with the Insurance Bureau of Canada. I'm going to walk us through IBC's annual review. So sorry, I don't see the presentation up. There we go. Next slide, please. So the focus for our presentation today will be on 4 key areas. I'll first begin with an overview of the current state of the industry, looking at recent trends, market conditions, and the regulatory environment. Next, I'll delve into factors that are driving the projected loss trend rates identified in this annual review. I'll then move on to discuss the profit provision and the impact of a reduced benchmark. And then finally, I'll present our recommended next steps, highlighting our proposed actionable strategies for addressing current challenges. Next slide, please. I'll now walk us through the current state of the industry and system cost pressures that are underlying premiums. Next slide, please. So Alberta's auto insurance premiums face some of the highest cost pressures in the country, and it's very clear through the factors identified in this review that the market remains in crisis. Claims costs continue to outpace premiums that carriers are able to charge under the current rate interventions. And in this environment, Alberta has the highest bodily injury loss costs in Canada, and notably, the average bodily injury claim cost has increased 116% since 2013. Alberta has the second highest physical damage claim size, and in addition, the province has the second highest for the cost of auto theft per average premium in Canada. So in addition to these cost pressures, legal costs account for a greater portion of the auto insurance premiums drivers pay in Alberta than anywhere else in Canada. And since 2018, lawsuits and legal costs associated with insurance claims have increased 31%, and they now account for 20% of mandatory premiums. And in addition to this, over the last 3 years, we're seeing an increase in spending on vehicle parts and repairs, which was up 15%, while the cost of new vehicles has increased about 13% as of December of 2023. And on auto theft, since 2021, the cost of these auto thefts has increased 55% across Canada. So those are claims cost figures. And cash settlements for minor injuries under Alberta's minor injury regulation went up 4.2% in 2023. And finally, the Alberta Healthcare Levy on auto insurance premiums for next year, so 2025, is now set to increase by 25%. So the data presented in this annual review confirms that there remains claims cost pressures within Alberta's auto insurance system that are unsustainable, in addition to the other factors that I've outlined. So next slide, please. Looking at the loss trend factors, this year Oliver Wyman projects that claims costs for injury coverages are once again expected to increase considerably, and in particular in excess of the current rate cap. Oliver Wyman selects a trend factor of 8.7% for bodily injury claims and 13.2% for accident benefit claims. And these trend rates reinforce the need for immediate action to address rising legal costs in the system. So Oliver Wyman also projects that comprehensive claims costs will continue to rise by 3.6%. And in our analysis of the review, we believe that comprehensive rate pressures are likely to be understated and do not fully account for inflation and severity trends. And in light of this, we recommend that this trend factor be adjusted higher to account for this, as done with other coverages. And finally, as outlined in our submission, Oliver Wyman notes that the large increase in the number of auto thefts since 2011 contributes to higher comprehensive loss costs. So as you are all aware, auto theft is a national crisis that's impacting Canadians across the country, and including here in Alberta. So between 2021 and 2023, as I've noted earlier, auto theft claims costs have increased 55%. And tackling the auto theft issue really requires a whole of society approach. So IBC has a suite of recommendations that we recommend to government, and we would hope that the ARB could educate government on the impact of auto theft losses on the insurance industry. So our recommendations are threefold. First is to provide more resources for coordinated interagency enforcement. Second is to bolster enforcement capacity by creating provincial auto theft teams with dedicated prosectoral support to strengthen provincial capacity to police and to deter organized crimes involvement in auto theft, as was recently done in Ontario. And the third is through Service Alberta, is to eliminate the current VIN override policy to ensure registrations cannot be issued if a VIN fails to conform to VIN verification databases. So as I've stated, the trend factors presented in this review really confirmed the significant cost pressures in the system and underscore the fact that the current regulatory environment is not sustainable and does not allow insurers to keep pace with rising and mounting claims cost pressures. And IBC stresses the importance of the ARB ensuring that rate filings are reviewed based on the reasonableness of those rate filings to ensure that market competition and consumer choice are not hindered further. Next slide, please. Thank you. So, sorry, I'm just going to close my email. Despite Oliver Wyman selecting modest increases in property damage and collision coverages, this annual review states that inflationary pressures on physical damage coverages have resulted in the highest inflation in the last 10 years. And given these inflationary pressures that remain for Alberta insurers, we believe that insurers should be permitted to reflect real-time CPI data in their rate filings. And this can be based on StatCan data elements, which I've listed here, but they include the value of new and used vehicles, vehicle parts, accessories, and supply costs, private passenger vehicle lease costs, and rental of passenger vehicle costs. Giving insurers the option to consider these data elements for their rate filings will help ensure that they can reflect some of these inflationary pressures that persist on the physical damage side. So next slide, please. So for this section, I'm going to focus on the profit provision and the current situation for Alberta's insurers. Next slide, please. So Alberta has been a very unprofitable and desirable market for much of the last decade. The decision to lower the profit provision from 7% to 6% has proven quite challenging, in particular on top of this the current regulatory environment. Insurers have paid out more in claims costs, operating expenses, and premium taxes than they earned in premiums and investment income. As outlined in the September 2023 Superintendent's annual report, which highlighted just how challenging the market really is, the report indicated that 17 insurers lost money on the sale of auto insurance in 2022, demonstrating just how challenging it is for carriers in the market. And in addition to this, the most recent data from MSA reconfirms these challenges, showing that in the first quarter of this year, so for 2024, Alberta's private passenger auto insurance service ratio was 110%. This means that insurers have incurred 10% more in claims and expenses than they earned in premiums. So given the current challenging market, carriers have been actively withdrawing from the marketplace or restricting coverages that they're offering. Of note, one carrier exited the market last year, and in recent months, two have announced their withdrawal this year from Alberta's auto insurance market. As we all know, market competition is quite crucial to providing Alberta drivers with more choice and coverage options, but the current state of the market has created significant, perhaps unintended consequences for consumers with less choice and likely higher premiums. It's crucial that the AIRB work to attract capacity to the marketplace, particularly under the current regulatory environment. And to do so, we strongly recommend that the AIRB return the profit provision to the previous 7%. Next slide, please. Okay, so I'll now walk us through IBC's recommendations for the AIRB and government alike. Next slide, please. As I've highlighted throughout the presentation, there remains considerable uncertainty in Alberta's auto insurance system. This review has identified and reconfirmed that there are significant system cost pressures that are not sustainable and that are projected to get worse. It's crucial that the AIRB work to alleviate system cost pressures and work to attract insurer capacity back to the market for the benefit of the province's 3 million drivers. We believe that there are 3 actionable solutions for the AIRB, which they should and can undertake to help improve the auto insurance market for consumers and insurers alike. This includes allowing the use of current CPI data and rate filings, returning the profit provision to 7%, and move to a use and file rate filing system following government's announcements of reforms later this year. So our submission details these recommendations further, as well as recommendations pertaining to grid-based premiums and the Alberta Bulletin, I believe it's 1023. So thank you for listening to IBC's presentation. I welcome any questions that the board may have.
Okay, thank you. Thank you for that presentation. I think we do have a few questions from the board. Jay, I believe you have a question. Oh, and Encore, can you take this presentation down, please? Perfect. Jay?
Thanks, Hannah. And I just wanted to thank IBC for its presentation. So IBC recommends that the AIRB consider increasing from the current 6% profit provision to 7%. So the Ontario regulator, FSRA, allows 5% as a profit provision. Just, I guess, as our closest neighbor, Saskatchewan, SGI utilizes a 6% profit provision. Can you just elaborate on why IBC recommends that it be reasonable for drivers in Alberta to see rates based on a 7% profit provision, which is notably higher than the profit benchmarks in other provinces?
Sure. Yeah, great question. So as you know, the benchmark was 7% and was recently lowered to 6% over the past year or so. Alberta, as a province itself, continues to see some of the most volatile weather across the province and compared to other regions. This creates additional claims cost pressures that need to be accurately reflected through a higher profit provision to allow insurers to use their capital accordingly. And we recognize that the profit provision may differ across the country. I believe one province in the Atlantic region has a 7% profit benchmark. But just given the history of volatile weather specifically, and especially under the current rate interventions that insurers have been under in Alberta, they had the rate cap from 2017 to 2019, and then we had the rate pause for a year, now the Good Driver rate cap. So these are rate interventions that we don't see across the country, and so they're really having an impact on insurer capacity to operate in the market on top of the history of volatile weather. So that would be our recommendation as to why the profit benchmark should be increased back to 7%.
Thanks.
Thanks for the question.
Vince, I think you might have a question. Go ahead.
Thank you, Mr. Chair. Thank you for your presentation, Hannah.
No problem.
I'm just curious, what steps can the Insurance Bureau of Canada take with its members to reduce the total expense provision with 27.6%? of the premium, the expected average for private passenger vehicles.
Sorry, it cut out just a little bit on my end at the last part. I've got a bit choppy Wi-Fi here. Do
Well,
you mind repeating the latter half?
Yeah, the total expense provision, right now it's 27.6% of the premium, which is the expected average for private passenger vehicles.
Mhm.
So what steps can IBC take with its members to reduce this expense provision?
That's not something that I can answer right now. But what I will say is we know that over the past years, Alberta's expense ratio has been lower compared to some of the other provinces operating with a privately delivered auto insurance system. And we do know that it, with the exception of the past year, we do know that it's been considerably lower than what we've seen in ICBC, with ICBC's expense ratio, which ranged around 34% over the past few years. So I'm happy to take that question back and discuss it internally and with some of our members if that helps, Vince, and we can connect after our presentation if that works.
Okay, thank you, Hannah.
No problem.
Great. Rita, I think you might have a question.
Thank you, Mr. Chair. Hello, Hannah. Thank you for the presentation.
No problem.
For IBC recommends the use of CPI data rate filings.
Yeah.
And where Oliver Wyman selected the trend rates, consider recent CPI changes were statistically supported. And so the current practice is to consider the CPI in the rate filing submission for changes in the future trend rate. I'm just curious in terms of the specifics, and maybe you can't get too much into the detail, but it would be helpful just to be able to understand what does IBC recommend that be done differently?
Yeah, for sure. I'm happy to answer that question. So where our recommendations here came from is a few years ago, I believe it was in the 2022 annual review and perhaps 2021 as well. So the Oliver Wyman report did specify these specific data elements that could be used in insurer rate filings. And then after, I believe it was the 2022 annual review, it was no longer included as recommendations. So we just want to ensure that insurers are still able to account for those inflationary pressures that persist on the vehicle damage coverage side. So that's where our recommendation is coming from, to ensure that they are able to account for those. And we're using the StatCan data elements as recommended by Oliver Wyman in the past few reviews, but hasn't been included in last year's or this year's. So that's where they came from.
Okay, thank you.
No problem. Thanks for the question.
Okay, Kathy, I think you might have a question.
No, actually, I didn't. Sorry.
Oh, okay, no worries, no worries. I have a question. So
Sure.
IBC recommends a use and file rate filing system following reforms.
Yes.
Can IBC comment on the reasons for the limited use of the current file and use without approval up to plus 5% for PPV? As full reform implementation may take considerable time, do you envision any increase in the usage of the current file and use without approval?
Sure. Good question. Thanks for the question, Mr. Chair. I think, just given the current challenging regulatory environment that insurers have been under, we've had the rate pause for a full year, the good driver rate cap. We have the 10% rate cap under Bulletin 1023 under the ARB. And insurers are not able to deliver some of these rate filings to consumers. So this is where we're hoping to operate under a use and file system. Use and file really has direct benefits to consumers. It allows them to see those changes quicker, even declining rate changes. So that's sort of some of the benefits of that. I'm happy to answer this question further offline, Mr. Chair, if that helps to provide more specifics around the benefits around that. But we do know, once government recommends or implements their changes in the fall or announces those changes, it will take some time for those changes to come to fruition. And allowing use and file will help really ensure those flexibility while they're also, dealing with system changes on the back end as well.
Oh, well, thank you. That's great. Yeah, and if you want to provide more detail, you can just
For sure.
send an email to us through Lori.
Yes.
Yeah, so because again, we want to make sure we sort of understand all the components of your presentation. So
Yeah,
that's
we do have our whole suite of recommendations and our fleshed out use and file proposal as well, which we're happy to discuss further. And if the ARB board will have us at an upcoming board meeting, we're happy to discuss the benefits of use and file and our recommendations forward for that as well.
great. So I would encourage you maybe to have a conversation with Lori then to see
For
if we
sure.
can sort of work that out in the future. But great, thank you very much.
Sounds good. Thank you, Mr.
Well,
Chair.
Thank you for your presentation and have a great rest of your day.
Thanks so much. Take care, Ron. Bye.
All right, closing today. So that doesn't conclude the today's presentations. On behalf of the ARB board members and staff, I would like to extend our thanks to everyone in attendance. We appreciate those who took time to provide written submissions and make presentations today. Input from those engaged in the industry is an important component of the annual review process. All feedback and comments are welcomed and appreciated. The ARB will consider the information received from today's presentations and the written submissions as it deliberates the setting of industry benchmarks, which will be used in our review of insurer rate filings effective October 1st, 2024. The benchmarks are used in the review of rate filings to assess the reasonableness of insurance-specific data and assumptions. Insurers are expected to use their data where credible. Where an insurer's results differ significantly from industry results, we will seek additional information and support to understand those variances. We will consult with our actuary, Oliver Wyman, to determine if any additional information is required to finalize our 2024 annual review report, which the ARB must post on its website no later than September 30th, 2024. As a reminder, following today's meeting, the presentations will be posted on our website. A video recording of today's meetings will also be available on our website no later than August 31st, 2024. We encourage everyone to follow the ARB on social media to stay up to date on the great work we are undertaking, learn about the trends in the industry, and be reminded of safe driving tips. Again, I would like to thank today's presenters for assisting us in gathering information and data to support our decisions for the industry benchmarks. I would also like to thank Encore for their work behind the scenes assisting with today's presentation. And having said that, the meeting is adjourned. Have a great day.